Hi, it's Stephen Molnar here, and I'm joined by Konrad Bobilak, who's the CEO and founder of Investors Prime. Konrad, just want to ask you a question relating to area. It's probably one of the most important things. So we're in beautiful Melbourne here, so tell me about the area that you've chosen and why in terms of investment.
Thanks, Stephen. One of the things that agents will tell you is that location determines capital growth. And I think that's the biggest lie that I've heard over the years, and I'm a real estate agent. Because if you really look at location, it doesn't really determine capital growth. What really determines capital growth, and this is kind of part of me answering the question, is a number of things. Number one is Melbourne is valued by the distance of a property to the city and distance of the property to water. But beyond that, the most important thing about an area, if your objective is for capital growth, if it's for lifestyle, you can, buy it anyway.
Yeah.
But if your objective is to get the highest possible capital growth, you have to invest in an area where there is very high income per household,
Yes.
which is the most important thing.
Because they can afford it, yeah.
Absolutely. And combined with scarcity of supply.
Right.
Those two things create pressure on housing, houses go up. The biggest lie is location. Pretty areas on the water, but if they're 60 or 100 k's from the city and the income per household is very low, you're not going to get a lot of capital growth.
Sure.
The other biggest lie that I've heard also about capital growth is infrastructure. We've seen dozens of examples over the last 10 years in Australia, especially in Queensland, where there are billions and billions of dollars invested in an area, and there's virtually no capital growth in the area.
Yeah.
And yet everyone expects, because of these billions of dollars invested in there, there's going to be a lot of capital growth. The problem with a lot of these areas is that there is infinite land supply.
Yes.
So there is infinite housing developments that are occurring all around the infrastructure developments.
Yep.
There could be a hospital, it could be a highway, it could be anything. But the most important thing is, not only is there infinite supply, the household income is very low.
Yeah.
Ipswich is a perfect example.
Sure,
why there's
yeah.
low capital growth there.
Yeah.
Because you've got infinite supply and low incomes.
That's right.
So I guess for the people listening to this video, if your objective is to get the highest capital growth in an area, whether it's Melbourne, Sydney or Brisbane, the most important thing to look for is scarcity of supply. So if you look at, for example, where we are currently in St Kilda, St Kilda is a perfect example of an area where there is extreme scarcity of supply.
Absolutely. Yeah.
This is the area where Save Our Suburbs originated from in Melbourne. People
That's right.
hate developers in
Yes.
St Kilda. They're just
The council's so against developers.
Absolutely. And you've also got things like you've got heritage protection, you've got single dwelling covenants on blocks, you've got height restrictions, density restrictions.
Yeah.
It's very difficult to actually develop something in St Kilda, so that's substantial. There are a number of streets in St Kilda where there used to be industrial estates, now they're converting into residential estates.
Yes.
But if you look at the core suburban streets in St Kilda where we've got single fronted terrace homes or Victorian, or Edwardian or Victorian properties that are owned individually by individuals, it's very difficult to put a development there. So the areas that I choose to invest in, to answer your question, are areas in Melbourne, predominantly in the Bayside, inner south and southeast, because that's where the money is. Number one, you've got the best schools in those areas.
Does that play an important part?
Massive.
Right.
If you look at, for example, and I'll just give you a random example, McKinnon High in McKinnon. It's a public school, top school in Melbourne, right? So you can send your kids there for free. Effectively, you're getting 25 grand worth of education per year for free.
Right.
However, you
Per
have
child.
to be in per child, yeah.
Yes.
So you've got 5 kids, adds up.
Yes.
But you've got to be in the catchment area.
Right.
If you're outside the catchment area, if you're literally on the wrong side of East Boundary Road,
Right.
you can't get into McKinnon High.
So tell me, how does that reflect in property prices?
Well, I'll give you an example. Metricon does a lot of developments in McKinnon, Bentley, and those areas, and
Right.
they do a really good dual-lock development, which is 2 townhouses joined together.
Yes.
4 bedrooms, quite large.
Uh-huh.
If you look at the catchment area, you're looking at 1.15, 1.25 million per townhouse.
Yep.
If you look at across the road in non-catchment area, you're looking at least 150,000 to 200,000 below the catchment area
For the same build quality.
Identical build.
Right.
10 meters away from the other property.
Right.
So schools are definitely a big thing, especially with ethnic communities. You look at the Chinese, look at Russians, I'm Polish. Our parents migrate to the country with the number one priority is kids' education.
That's
and
right,
people
yeah.
pay a premium, for schools in Baldwin, Glenwaver is another area.
Yep.
Where people will specifically seek out those areas and pay a premium. But beyond that, if you look at the core fundamentals that make up an area and capital growth, what you've got to look for is scarcity. limited supply, limited stock coming onto the market, combined with household income that's very high, where you've got people that have the ability and willingness to pay above market.
Yeah.
And areas like St Kilda, Albert Park, Middle Park, Elwood, these are the prime areas in Melbourne.
And Brighton.
Brighton, Hawthorn, then you've got eastern
Sure.
suburbs. People have got a lot of money there. There isn't a lot of supply coming onto the market, and they've got the willingness and ability, which is very important, to pay above market.
So, so there's not a lot of new supply coming on, but I would imagine the people who have children, particularly if they've got several children going to those schools, they're going to be staying put for quite a while. So it'll be tightly held.
Absolutely. Some of these families will definitely move there, stay in the area for 10 years, 5 years. If you look at tightly held streets, there are streets in St Kilda, for example, like Mary Street, which is in West St Kilda, or St Kilda West, which is one of the most tightly held streets in Melbourne. Some of the properties in Mary Street have not been on the market for the last 60 years.
Right, that's pretty
60
incredible.
years, which is incredible. They've never been sold.
It's a long time to wait, yes.
Yeah. So considering the average suburb has a turnover of stock every 9 years now, it used to be 7 and just gone up to about 9.5. Imagine streets where the property hasn't been resold in the last 60 years. Because really, these areas, like your St Kildas, like your Port Melbourne, Albert Parks, your Brightons, once people move into those areas, there is nowhere really to go. You can't upgrade from those suburbs. They're lifestyle, iconic suburbs of Melbourne. So if you're an investor, you've got to appreciate those dynamics. And then you've got to really seek out the best property that works for the area. But the most important thing is to appreciate the fact that if you have an area where there is low income per household and infinite supply coming onto the market, which is your fringe suburbs of Melbourne, the so-called growth corridors, you're going to get very limited growth. You will get some growth because you've always got inflation, you've got bureaucracy, you've got the cost of producing brand new blocks, but you will never have the premium growth that you will be experiencing in suburbs that are already overdeveloped and limited in how much supply they can create.
Right, that's great. Look, can I actually ask you one further question relating to those outer areas, because they're often called mortgage belt suburbs as well.
Yeah.
So what actually happens in your experience in terms of the growth of properties in those areas when there's interest rates go up or there's a downturn compared to the growth rates of properties in say a Brighton or somewhere like that?
Yeah, the biggest challenge facing the growth corridor suburbs, I'm talking about your Point Cooks here, your South Morangs, your Berwick's, your Pakenhams, is the majority of people that live in those areas are either blue-collar workers or entry-level white-collar workers, and it's the first home that they're buying.
Yes.
And the moment they buy their first home, they might even upgrade to a second home, but eventually they want to move out of those areas and come closer towards the city. The problem with the mortgage belt areas is that if you look at the leverage or the amount of lending per household in those suburbs, some of these most people in those areas have got a loan for around 90% LVR or 80% LVR. Where if you look at an established area, like your South Yarra or your Malvern, most properties there are unencumbered. Completely paid off, some paid off decades ago. So the pressures that those properties have and those people have completely different pressures in different areas. And as manufacturing is continuously shutting down in Victoria, Ford and Mitsubishi and Toyota exiting the market, etc., you're going to see a lot of layoffs in those areas. And the first thing they do is when they get laid off, they can't get another job. If the factory shuts down, they're unemployed, the first thing that happens, they lose their house. Now when they lose their house, and that happens on a large scale, and because all the properties are virtually identical, because they're all built by Siemens Metric, they build the same type of property over and over, you cannot differentiate your property.
That's right.
So what happens is, if you want to fire sell your property, you're going to take a massive hit.
That's right.
If you're living in St Kilda, for example, we are right now, and you default, you lose your job or something happens, and you own that little apartment over there, that little Art Deco apartment just in front of us, they'll get sold in 3-4 weeks.
Because there may not be any other Art Deco properties that are one-bedders on the market at all.
Exactly.
Is that what you, yes.
So if you look at the amount of volume of listings at the moment, if you look at houses in St Kilda,
there
could be 10 houses on the market. You look at Point Cook, there's 350 houses on the market right now. Anyone listening to this now, just check out realestate.com.au and check out how many houses are listed right now in East Melbourne, West Melbourne, North Melbourne, Middle Park, Albert Park, Brighton. You're looking at, Elwood, Elstonwick, you're looking at 10 properties, 15 properties. Look at South Morang, Derrim, Point Cook, Trigonina, Tarneet. You're looking at hundreds and hundreds of identical houses. And, the rule is, and this is one-on-one economics, supply and demand.
That's right. So as an investor, as part of your risk mitigation, you have to think about the area in terms of what if something goes wrong and what will that do to other people and ultimately your valuation and your ability to get the next one and the next one.
Absolutely. And we saw the worst of it during the GFC. During the GFC, you saw mortgage defaults in those fringe suburbs go up to 20%, 30%.
Yep.
And the problem with the GFC was that there were a lot of bargains on the market. So a lot of people made a lot of money during the GFC. I know developers personally in Melbourne that were just buying up development sites everywhere for cents in the dollar.
Yeah.
Because the banks were liquidating developers, and so a lot of smart cashed up developers did really well. The problem with the fringe suburbs is, even if you've got equity in your own house and your job is safe, you're seeing bargains all around you,
That's
but
right.
you can't access your equity
Yes.
because your valuation's getting smashed because
That's right.
everyone's fire selling
Yeah.
everything around you. So it's a double-edged sword.
Yeah.
You
can't get onto your next one.
Exactly.
Yeah.
So you're paying the price for other people losing their job as well.
And that might actually take years to recover.
Absolutely. And not only that opportunity might be once every 20 or 30 years. You know? I mean, during the GFC, a lot of people made a lot of money, a lot of people lost a lot of money.
Yeah.
The difference was that it was a transfer of wealth from the uneducated to the educated. And that's exactly what happens during recessions and depressions in the market.
That's right.
It's opportunity, but you have to be prepared. You've got to do the hard work.
That's great. All right, that's wonderful. Thanks so much for that, Konrad.
Thank you, Stephen.